All right, welcome. Let's get started. One more time, I want to make sure everyone can hear me pretty well and you can see my screen. If you drop some ones in the chat, please let me know. I know we have a limited amount of time to go over a lot of information, so I really want to jump right into it. Thank you. I know it's a Monday and you all decided to spend your Monday with me. I think that is pretty amazing to talk about the boring stuff. But this boring stuff is really life-changing. I would just definitely tell you all that it's really life-changing. I want to definitely let you know that you're not wasting your time. Over the next few moments, I'm really going to probably go a little bit deeper into specifics on how the structure of policies work. The next 3 days, we're going to do a really deep dive over 3 days. I haven't done this before, so please take your time if I'm all over the place, but I'm going to really break down everything in specifics. What I've learned is that a lot of people, when they come to me, from wherever you come from, we're in a situation to where you come from a very broad standpoint. And a lot of you struggle with really understanding how this thing works is because you're in a situation to where you're thinking very broad. You have to dumb down your scenario and look at your personal scenario. There's a million of scenarios out there when you're dealing with these types of cases, and I'm going to explain that. But I want you to understand that you need to get to a point to where you know how to dumb down your scenario to where you understand how to go from where you are to where you got to go. Most people, what they do is they look at, okay, let me look at step 10 and let me figure out how to go from step 1 to step 10. No, you want to figure out how to start at step 1 and work your way up. So I'm going to break this thing down as simple as possible. Of course, we're going to be talking about insurance, but I want you guys to understand the history behind insurance and why insurance is so broad. So then you will understand why we're qualified to talk about the 401ks, the IRAs, the SEP 403bs, why we're talking about index accounts, why are we talking about taxes, why are we in a situation where we're competing against banks. When you understand the history and the foundation of why wealthy people are putting their money in certain places, then you will understand that, hey, this is why you should put your money there. Not just put your money there, but have a clear understanding on how it works. Okay, so let's go ahead and let's jump right into it. When you're in a situation, and I'm going to speed through it because I don't want to spend too much time on things that are repetitive. When you're in a situation where you're talking about insurance, okay, when you're talking about insurance, the first thing that people that comes to people's mind is, okay, when you get insurance, when the person died, you get 10,000, 50,000, 100,000 worth of coverage. I want you all to understand that when you're dealing with policies, there are different types of policies, multiple different types of policies. Now, I know the first thing that you're thinking about is it a term policy? Is it a whole life? Is it an index universal? Is it a variable life? Get yourself out of thinking about the title. The title really doesn't matter. What you want to start understanding is the difference between several policies are the structure of the policies. I can have a whole life, you can have a whole life, and they may not look identical. I can have an index universal life, you can have an index universal life, but it may not look the same. It may not have the same structure. It may not have the same use cases. So when you're in these situations to where you're having these conversations, you want to make sure that you understand the scenario on why you got that particular policy. The second thing you want to understand is the fact that you cannot have multiple scenarios built in one policy. I don't care what anyone says. Do not let anybody convince you to mix multiple scenarios into one policy. I'm going to explain what that means in a later point, but I want you to just get that. Now, let's just say, for example, we're getting a basic insurance policy. We're getting a basic insurance policy typically for what? The death benefit. We're getting it for the death benefit. There's a minimum amount that one person can pay for a certain period of coverage. Most people don't know that there's also a maximum that you can pay for a certain amount of coverage. Okay, so let's go back. There's a minimum amount that you can pay for coverage, and there's also a maximum amount that you can put towards this policy to pay towards the coverage. The minimum amount is determined by the insurance company. Okay, so the insurance companies will say, hey, let's be in a situation to where we do a background check on this particular individual. Let's say Sally. Sally's 45 years old. She's 45 years old. What are they going to look for? They're going to look into your medical records, your criminal background, your felony history, your driving records to determine if Sally is not only insurable, but up to how much. Okay. Majority of you all don't have enough insurance. Okay. Write that down. I don't have enough insurance. Okay. But majority of you all don't understand the value of it either. So that's why we are having this conversation. So when the insurance company, they do the background check, they look into you, they look into who you are. I want you all to understand the seriousness of how insurance companies work. They will look into your, not only your medical records, but they will also look into your ParaMed exam. For a lot of you all, you may qualify for ParaMed. That means that we need to send out a nurse to do a physical on you. When they take that information, they're basically saying, they're measuring how much you are worth. When you put in that application, you're asking for a certain amount of coverage. On their end, they're stating this person is only worth this certain amount. Okay? More than likely, none of you all are hitting that amount that you quote unquote you're worth. They don't even expose what's the amount that they say you were worth. They'll just go ahead and prove you. Now, let's just talk about the maximum. The maximum is determined by the government. So you have some people that use the policies just for coverage. You have some people that use the policy for asset protection. That's two different ideas. So remember, I said you can use the policy for multiple reasons. You don't want to mix multiple scenarios into one. Now, as you're continuously going and you're putting money into this policy, you want to understand that depending on how you decide to start the policy, what you're applying for determines if we're building it for the death benefit or we're building it for the premiums. If a lot of you all had a conversation with me, we don't talk about the death benefit. There's no need. We only talk about the premiums, and the insurance company will determine the death benefit. For some of you all, when you're used to talking to people that do insurance, they're talking about the death benefit, which is 100,000, 200,000, 50,000. Okay. And then you're looking for a quote right after that. Are y'all with me? Put some ones in the chat. Those are two different scenarios. And I'm going to explain why. I'm giving you very clear details on why. The insurance company determines the first scenario. The government determines the second scenario. So that means that we need to focus more on what advantages the government don't want us to take advantage of. Okay? Now, as you're continuously going, I want you to understand the history of it. In the night before there was 401ks and all these other vehicles where you could put your money, people were putting their money into life insurance. Okay? Life insurance was a protection. Before it decided to be a protection, there were so many individuals. There were, let's say, when most women, they weren't working. Okay? The husbands would go to work or they would go to war or whatever, and the husbands may pass away. And what's going to happen is, majority of the time, if that wife is not working, that husband don't have anything to pass down. So they would get insurance. What happened is the law started to change over time because they started to notice that when the husband gets the insurance, there are creditors that go after these particular widows, and they try to get money from these widows. So they decided to put some type of protection on the insurance, and they would call it widow's insurance. So when we have these conversations about why is the government involved in life insurance, it stems from that. It stems from the idea of protecting widows from not having their husbands or their family's wealth being taken away from them. Okay. Fast forward in the 1980s, the government decided to pass laws limiting how much money one could put into an insurance contract. So not only did they get the actual life insurance, the husbands were storing their money into the insurance policies as well, because they knew that they could not count on the banks. They knew that they could not count on other vehicles, because those vehicles would not leave their wives or their spouses or their relatives with anything. Okay, let's keep going. The reason why life insurance contracts are now a big deal past the 1980s is because they started to compete with qualified plans. Okay, what are qualified plans? A lot of you all, if you're in a situation to where you are at an employer or you have an employee or whatever, you are participating in these qualified plans. Now, the reason why you will participate in these qualified plans is because they will guarantee you, saying, hey, we're going to give you some type of security. We're giving you security because when you work here, what's the first thing somebody says when they want you to go find a job? Make sure it has benefits. The qualified plans are nothing more than just benefits that your job offers. Okay. If your job doesn't offer it, you have the ability to go to these financial institutions, Charles Schwab, Fidelity, all these other companies, and you have the ability to try to get it yourself. Now, what happens when you put your money in these vehicles? What are some of the benefits? I'm going to explain. Some of the benefits is, number one, being able to write some of the funds that you're putting towards these vehicles off your taxes. Okay. Number two, understanding that there's long-term growth. So a lot of people are not in a situation to where they are able, not only are they not saying they're not able, but they don't have the maturity level to put money away. Especially today when you have Amazon, especially today when you got FedEx and you got the mall sitting in your hand. So it's very hard for you to put money away. Okay. So the discipline back then, it was a little bit way better than it is now. So it just made sense because they realized that the wealth gap was getting larger and larger based on generations, because every generation is spending their money a little bit too loosely. So they put together these particular restrictions to force people into saving their money. And they also incentivize them along the way. Well, what are some of the incentives, Keyon? They incentivize the employers by saying, hey, the amount of money that you match those employees that you have, you're going to now to be able to write it off on your employer taxes. So a lot of y'all think your employees are nice or they really just like you. A lot of times it doesn't stem from that. It stems from the benefits that they get by incentivizing you to put your money into these vehicles. They also did studies and they realized by putting money into these vehicles, you have the opportunity to actually work there longer, because you would think twice about leaving your employee or your employer if you realize that you have hundreds of thousands of dollars sitting with the employer. you will think twice about leaving them. So it's also an incentive tool for them to be able to retain you as an employee, to where the other competitors, we can't compete with them because you don't have money with them. You got money with us. All right, stick with me. If I'm getting deep, just understand I got to do it. All right, let's break this down. So understand the life insurance policies have been here. Only difference is they're not treated like these qualified plans. They're not in the same family at all. Now, when you're dealing with life insurance policies, let's break this down. The premiums are already pre-taxed. So no one is looking at taking the money and trying to tax it again. Okay, that's a big deal. Taxes are a really big deal. I don't think people understand how much money they spend in taxes. Okay, anything that you buy outside of gas, you pretty much are paying taxes on. Okay, there's no government limit on contributions. Now, most people that don't know what they're talking about will say there are limits. Okay, we're going to explain to you why there are not any limits. Okay, tax deferred growth. What does that mean, Keyon? Compared to these vehicles. So remember, we're talking about a bubble. We're talking about a family. This is all one big family. Okay. This just so happened to be the cousins, and this just so happened to be the uppity side of the cousins. So they relate, but they have some differences. The differences is the taxes over time. And I'm going to go into details in regards to why taxes are very important. Okay. Now, here's a pop quiz. When you're in a situation to where you are trying to buy a $1 million home, you bought a $1 million home, how much money do you need to have a $1 million home? Somebody drop it in the chat. How much money do I need in 2025 or 6, we can just say 6, to have a $1 million home? To purchase a $1 million home, how much do I need? Somebody said at least 10 million. Okay. How much cash do I need to have a 1 million? It's not a trick question, I promise you. How much cash do I need to purchase a $1 million home? Today, if I want to purchase a $1 million home. Okay. Okay. I'm looking at these answers. Pretty interesting answers. It's not a trick question, I promise you. You just need $1 million. Okay. If the home is $1 million, you got $1 million, you can pay for the $1 million. Now, everything else, I mean, I don't know. I'm not going to get in that deep. Okay. The reason why I asked you all that is because we consider that an asset. We consider that home an asset. Okay. I'm going to ask you again. Now, how much do you need cash today to purchase a $1 million life insurance policy? I think I just got another policy, but when I got my first $1 million policy, it was $45 cash. Okay. I spent $45 on this one insurance policy, on this one asset. Okay. And I'm not talking about to keep it. I'm talking about just having it. $45. I have an asset. It's $1 million worth of coverage. If I wanted to go purchase a $1 million home, I need $1 million. That's a big deal when we're talking about assets. A huge deal. Because if anything was to happen, I was 22, 23. Okay. So if anything was to happen and I need to pass down my home, guess what? My family's going to get that $1 million. But guess what? I paid $1 million. Now, what's the difference? There is no difference. If anything was to happen on this side with the life insurance policy, I paid 45, but my family's going to get that same 1 million. So I want to open your mind up to realize that, wow, there's a big difference. Why do we call, well, there's a big difference. That's about 900 and some $1,000 of a difference. Okay. Now, you also have to look at the access to the account values. So when we're comparing it, I'm comparing it to real estate. I'm comparing it to IRAs. I'm comparing it to 401ks. And I'm also comparing it to different tax vehicles. Now, what happens is the government, quote unquote, they say if you put a certain amount in that passes this particular amount for this particular policy, we're going to now call it a modified endowment contract, which is called a MEC. I guarantee you a MEC is not a big deal. Okay. I promise you it's not a big deal. I will explain further on a one-on-one basis on why it's not a big deal, but it just means that they will begin to send you a 1099. We know too much, as a community to really, really say that it's really not a big deal. It's not what people think it is. I'm gonna tell you what it's not. It does not mean that if you put 100,000 into your policy, they're going to send you a tax bill for $100,000. It just doesn't mean that. It doesn't mean that at all. Okay. So most people think that, but it doesn't. Versus the 401k, if you put in 100,000 and you pull out 100,000, they're going to send you a 1099 for $100,000. That's not the same thing. Okay. So modified endowment contract, we want to specify it is not the same as being taxed on the 401k. Okay. And I wish that people really clarify that because it's not the same at all. Now, what happens is as you're consistently putting money towards these particular vehicles, let's just say you got $500,000 worth of coverage. $500,000 worth of coverage alone, more than likely, that's called a term policy. That's all you want is just a term policy. They're going to say, hey, well, you're going to put $500 for the year towards this policy. $500 for the year. What is that? $40 a month. Okay. That is what we call, again, your minimum. That's the minimum that you're putting towards the policy. Now, again, understand this, especially if you're the person that's licensed, and I know we got a lot of people that are licensed on it. Understand, it's not about the title. Again, it's about the structure. So most people don't have access. If you're speaking to different agents, understand that most agents don't have access to what I'm talking about. So you want to be very careful with thinking that everyone has access to this because they don't. So $500 a year for $500,000 worth of coverage. That's the minimum. So they would say that's your annual premium. Now, when we're having these conversations to get a deeper dive, you want to say, okay, what is the max that I can put towards my policy? Typically, you would call the insurance company for that, and they would tell you, well, the max is $10,000. Now, the question is, why would I want to pay $10,000 versus paying $500? It's a great question. Amazing question. Is because we're not in a situation to where we're paying specifically for the insurance. The insurance just so happened to be our way in the door. This vehicle just so happened to be insurance. When you're talking about understanding how to utilize the wealth codes, become a wealth creator, become a legacy creator, you have to understand that there are rules to the game. And it's an open book test. It's an open book test because when you look at the IRS regulation, you look at 90% of what they say you can write off, then that the book is this thick and 90% of it is about how you don't have to pay taxes. Okay. When you look at so many different areas of where you're putting your money, you want to understand that it may be just that little page that you missed, that if you take advantage of it, it will set you apart from 99% of the world. Okay. So when we're talking about overfunding our policy up into 10,000, well, they wouldn't just have this one piece here for no reason. People, if it was easy to understand, everybody would do it. If it was this popular, everybody would do it. You would see insurance commercials say, hey, you need to go put $10,000 versus $500 into your insurance policies. Now, again, I broke it down for you. Why would somebody want to do that? Now, let's take a second and let's breathe. Let's think about what I was just saying. Now, why would somebody want to do it? I'm going to give you an easy visual on why a person would want to put extra money towards their policy. Let's talk about the first vehicle. This is an improved illustration. Okay. I'm going to break this down. An illustration, again, it can be edited. An illustration can be, illustration can be a lot of things. Okay. I don't take illustrations as serious Why? Because they're not statements. They're just hypotheticals. So I'm going to break this thing down to the T. What we're looking at right now, what we're looking at right now is a traditional whole life policy. Okay. For a lot of you all, 95% of you all, you need to start with a traditional whole life policy. Okay. And we're looking at a 45-year-old that has a health rating. Oh, I don't know what just happened. Give me 1 second. Uh, uh, how do I do this? Okay, let me try it again. Give me 1 second. 3, 2. All right, you should see now. All right, so let's just say a 45-year-old. I don't know how to move this, but let's say a 45-year-old, okay, a good health rating. They're going to put $12,000 a year towards this particular policy. Okay. The death benefit is going to start off at 114,000. 114,000. So remember when I was saying we're not in a situation, let's go back here. We're not in a situation where we really want to talk about this. We don't really want to talk about this. We want to talk about how much money can we put. So what is the minimum amount of death benefit that I can have to put towards this particular vehicle? I'm going to explain to you visually why would we do that. Okay. Now, the death benefit is going to be 114,000 starting off. I'm going to explain to you why that's important. When you're looking at these particular vehicles, again, becoming your own bank, again, it's a concept, but it's an idea that if you use it, it's going to make a lot of sense to you. So let's say this person, of course, they're doing 12,000 a year, $25,000 lump sum. Again, this is money that you either saved up, you got sitting somewhere else, whatever you want to do with that particular money. That first year, you've allocated $37,000. Okay. Now, when we're comparing vehicles, remember I showed you, you can't touch that 401k portfolio until you're 59 and a half, or they're going to tax you 10%, and they're going to tax you whatever your tax rate is, 20, 30%, and they're going to penalize you 10%. Okay. Let's break this down. So let's say, for example, I continuously allocate. This is my own personal bank. I'm making the decision to do this. I'm not depending on my employer. I'm not depending on the government. I'm not depending on nobody. I make a decision for the next 14 years. I want to allocate 12,000 a year starting off going towards this bare minimum. Okay. Well, let's just say, forget it. Let's say 15 years. Let's say 60 years old. Make it simple. 15 years, I'm allocating $12,000 a year going towards this policy. That's 180,000 plus I start off with 25,000. That's 205,000 that I allocated towards this policy. The insurance companies are not investment vehicles. So they will never tell you, if anybody tells you that this is exactly what your money is going to be, run, because they don't know what they're talking about. Okay. The insurance companies are not investments. The only thing that they allow you to do is to be in a situation to where they give you the bare minimums. So the bare minimums, what does that mean? You're in a situation to where you're in a contract between yourself and the insurance companies. So the contract will state bare minimum, this is what we're going to have to give you if anything was to happen, even if there's a war, even if the stocks were to crash, even if this insurance company, there are laws based on insurance companies that even if one insurance company collapse, every insurance company in that state has to pay equally to this particular contract. That's how serious insurance companies are. The documents that you're signing is not just a document, it's a document that's stating that these particular companies will obey by these particular laws. Okay. The reason why illustrations are kind of important is so you don't see the policy completely crash over time. There are cases to where policies do crash. Most people They don't know how to read these documents, so they don't really care to read it. They don't look at it. But over time, the policies could crash. So what does that mean? That means that you can have money sitting in a vehicle for 10, 20, 30, 40 years. And guess what? They did not tell you that your cost of insurance was so high that your policy will eventually crash when you get to a certain age. And when it's time for that person to pass, there will be nothing there. So when you see us read these types of things, that's what we're looking for. We're looking to see if long term will it be there. If I was putting $205,000 somewhere and for the next 15 years and it's not there, I would be very upset. So let's look at this. Next 15 years, 60 years old. All right, I've allocated a certain amount going towards this vehicle. Now, let's just say at the time, my benefit is $175,000. I'm sorry, $300,000. Okay. Remember, I'm allocating towards these vehicles on a consistent basis. So I'm starting somewhere, but I'm consistently putting money in this vehicle. Now, what happens to this 100? Let's just say it's 158,000 bare minimum. What happens to the 158,000? The 158,000 is sitting there as if, of course, just like where you sit anything. What you never want to do with the 158,000 is withdraw it. The reason why you don't want to withdraw it is because there's a difference between the word withdraw and loan. Those are two different conversations. When you withdraw the $158,000, they will then treat it like up here, the 401ks, the SEPs. When you borrow against the $158,000, you said enlarge it. Let's see if I do this. Does that work? Hopefully that works. If not, I'm sorry. I clicked the button. Okay, let's just say you enlarge okay. Let's say this 158,000. If you take a loan against the 158,000, that is not the same as withdrawing it. You want to understand the language for these particular vehicles. Okay, it's not the same. So when you take a loan against it, what is happening? I want you guys to look at this column. Remember, they're giving you a bare minimum guarantee. Okay. Now, of course, these are dramatic numbers. Everybody's numbers not going to look like this, but they're giving you a bare minimum guarantee. Your banks are not going to give you a bare minimum guarantee at all. All right. Let me ask you a question. Here's a question. Everybody can participate. The amount of money that's flown through your bank account over the last 10 to 15 years, how much money do you think has flown through your bank account? Let's just say, do you think have you been making at least 50,000 a year for the last 20 years? If you've been making at least 50,000 a year the last 20 years, that means that at least $1 million has flown through your bank account. Okay? Let's just say we redirect some of those funds. Let's just not even say all of it. Let's just say we redirected half of every dollar that you made, $500,000. Okay? Again, I'm just showing you this as a chart. Okay? I don't want you guys to even pay attention to this too much because it's about what you've remember, we're not looking at what we're actually putting in. We're looking at what is the max that we can put in. I want you all to get that. We're looking at the max that we're putting in. This 12,000 a year is just the bare minimum. This is the bare minimum number. Okay? I don't want y'all to think this is not a lot of money. This is not a max. This is not a big number. Why is it not a big number? Because your employer and this is what you're putting towards your 401k. Okay? So it's not a big number. You may think it's a big number, but it's not. The reason why they let you think there's not a big number at your 401k because you're not touching it. And they say you're investing into your future. So let's look at it like it's not a big number. Okay. The max is what we want to look at. This 12,000 a year is the minimum. So let's say $500,000 is going towards these particular vehicles. Let's say you allocate every dollar, you allocate that new money going towards your policy. Okay. If you decide to reuse that dollar, reuse the other half of that dollar, you will loan against the policy. When you loan against the policy, you would take that same 500,000, and typically you're supposed to go do, invest into income producing activities and things like that. Do whatever you want to do with your money. They're not going to ask you what to do with it, but we definitely suggest that you put it towards some type of income producing activity so it makes sense. Okay. But even if you don't want to do that, you just want to have the money sitting there. Let's just say it does sit there. What are some of the benefits along the way that you don't get anywhere else? Okay. Unlike your 401k, let's go here. Unlike your 401k, unlike your other vehicles, you're going to have to pay taxes on it. Now let's explain, what do I mean by taxes? Right now, if you look at the national debt, that's how they determine if taxes will go up in the future, based on the national debt. Right now, I don't even know what this number is, but it's a really big number, and it doesn't look like it's stopping. So we can all kind of predict that the tax rate is going to go up. So let's say, for example, you make a decision at 59 and a half to put that 500,000 in that 401k, and you want to take that 500,000 out. You take out 500,000 and you're the head of the household, you're going to pay 37%. 37% is $185,000. Okay. Now, if you got good tax people, it's going to go down a little bit, but I'm just letting you all know you're going to pay 185,000 out of the 500,000 because of where you decided to put your money. Wow, that's a big deal. We haven't even gotten started yet. So let's go back. Tax deferred growth. When you're in those vehicles, not only are you paying taxes on the money that you put in, but you're also paying taxes on the money that your employer put in. So you're paying double those dollars. You're really paying taxes on money that they got, that they wrote off on their taxes. Okay. So they're forcing you to pay taxes on that. Secondly, tax-free distribution. Okay. Well, what do you mean tax-free distribution, Keyon? Because we're only going to do loans. We're only going to do loans. We're never going to do withdrawals. When is the last time you paid taxes on the loan? I don't know anybody that paid taxes on loans. Okay? You may pay fees, but you don't pay taxes. That's a difference. Competitive returns. Now, I can go into details in regards to competitive returns. Why? Because I have a chart here that explains what has the S&P, let's just talk about the S&P 500. What has the S&P 500 done in the last few years? Let's just say we start the account, what do we say, $500,000, okay? That $500,000 is in a situation to where the first year in 2000, these are real numbers, first year in 2000, it took a 10% hit. Second year in 2001, it took a 13% hit. 2002, it took a 23% hit. Now, I don't know about you, but I wouldn't be able to sleep at night. Remember, insurance policies, you can't lose money because number one, it's not an investment. Number two, you can't lose money based on market volatility because they guarantee you a zero downturn potential. So even if you started with 500,000, you will still have 500,000 in the next 3 years, even if you did not earn a dollar. That sounds way better than putting your money in a space to where in 3 years, you're going to have $299,000. You've lost $200,000 based on ignorance. I'm showing you all how to save money, okay? So I just showed you how to save 185,000 on taxes. Just showed you how to save another 200,000 on downturn potential, meaning those are vehicles where, of course, the market is going to go up and down. You just lost value, okay? Very simple changes. Next, high contributions. A lot of you all, you don't want to put more money towards your 401k. Why? Because you're going to be penalized on taking it out and taxed. You can't put money into your IRA. Why? Because they're going to limit you to either $6,000 or $10,000 a year. A lot of y'all are like, man, I have way more. So even talking about 10, 12,000 a year, 10,000 a year, or $100,000 is not even a conversation for most of you all because you're putting it into that IRA because they will give you those limits. Okay. Now let's talk about additional benefits. What does that mean? Again, in 10 years, at 60 years old, 15 years, we're going to have $300,000 worth of coverage. On majority of those policies, they have what they call additional benefits. What are those additional benefits? What do they look like? Let me find it here. Somewhere where it says accelerated death, okay? That means that if anything was to happen, heart attack, stroke, cancer, they're going to release the death benefit while the person is still alive. Well, why is that a big deal? Oh my goodness, I did it again. Okay, forget it. Why is that a big deal? It's a big deal because if you look at how many people are in situations to where they are dealing with passing away due to terminal illness or chronic illness, or having some type of chronic illness without even passing away, a lot of them, they can't go back to work, okay? So that's why it's very important to make sure, of course, you have these policies structured very, very clearly and concisely, because that extra money is there to save you. Whether it doesn't matter how big or how small, any diagnosis could release those funds. Those funds could either set you up for retirement a lot earlier. I've seen people that look perfectly healthy that have gotten these benefits paid out to them. Okay, and now they're retired for the rest of their life. I've seen people who went through some very, very trying times, and now they're in a situation where, of course, those benefits had to be paid out, and it's paying for their hospital bills, it's paying for their nurses, it's paying for whatever it needs to be paid for. How do I get out of here? There we go. So that's where additional benefits comes in. Let's keep going. And remember, I'm going slow here, right? Collateral opportunities. What does that mean? For a lot of you all, you're in real estate or you're getting loans. A lot of you all have to get loans, have to get insurance for loans. So that means that if you're in a situation to where you're defaulted on a loan, there are some cases, and again, I don't want to get you all too excited, but there are some cases to where your collateral will be your insurance policies. This is how you will have banks or lenders back off from you, okay? Especially when you're dealing with whole life policies. There's so many times where you can go to the negotiation table and say, hey, listen, I don't have the funds right now, but I can make you beneficiary of my insurance policies that's already paid up and paid off. This is how we can guarantee you your funds versus trying to foreclose my home, or versus trying to close my business, or versus trying to do this. Give me an investment. My collateral is going to be my insurance policies. Where else can you do that? There's not too many places where you can have those types of conversations, okay? With insurance, you can't. Safe, meaning you can't lose your money, okay? No loss provisions, you can't lose your money. Guaranteed loan, options, that's very important. I didn't notice how important guaranteed loan options was until a lot of you tried to apply for a HELOC on your home, and you realize that you would get denied very quickly because if your credit is not together, or if you even try to loan from your 401k, you can get denied as well for several reasons. Especially if you really need the money, you just lost your job. Now you got to convince these people that you lost your job, and they say you don't have any income, and now they're saying that you can't loan your own money. I mean, it just really doesn't make any sense. So no one cares in the insurance companies. They don't really care what you're loaning for. If you need the money, they give it to you. Okay. And unstructured loan payments is very important as well, meaning that when it's time for you to put that money back, you put it back at your own time. Okay. Again, you have to have that responsibility because the people over here, they're going to keep you responsible, but there's a price for when they do it. The price is so big to where I'm going to show you how big the price is. Let's talk about fees, okay? Let's talk about fees. Let's just say, for example, we say, again, $500,000. And we're in a situation to where I'm going to give you an example on what your money will look like, over time with no fees. You start off that 500,000. In 20 years, that 500,000 is at 1.7 million with no fees. A lot of you all are in a situation to where you're promoting the 401ks, IRAs, mutual funds, annuities, whatever, and they have 2% fees. That 2% fee will bring you down from a $1.7 million to 1.1 million. Okay, so that's a $585,000 less than having no fees. And a lot of you all have hidden fees. So hidden fees is where they don't even really tell you. Hidden fees is where they really don't even tell you the specifics on the other fees. They just say is hidden. Those are hidden fees. A lot of you all, you think you're paying 2%. No, you're paying your broker 2%, but you're paying these other people some other percentages, which is typically going to cost you about $983,000 less. Okay. So don't you think it's important to have a contract that gives you a bare minimum? Because these other companies, they don't give you a bare minimum, okay, at all. They don't give you a bare minimum at all. And this is only on a 6% return, okay? So the average 401k portfolio is doing about 5 to 7%, okay? Average. I want you all to understand that there's a difference between actual interest and average. They may tell you their average is 14%. But their actual returns may be way lower than that, okay? Actual returns and average returns are totally two different conversations. Now, let's keep going. Are y'all with me? Are y'all getting tired? I know we're coming up on an hour. Drop something in the chat if you're still with me, if you're learning something. And this is only day one. Whew. There we go. All right. Now, let's break this down. Liquidity, use, and control. I want to show you all what it looks like for a 65-year-old to have $250,000 and put towards a policy. Okay. These are bare minimum numbers. This is called a single premium, meaning you will never, ever make another payment towards this policy again. You make one single premium payment, you never pay into it. I had a client call today. She ended up doing $100,000 2-3 years ago. Never made another payment. Never made another payment. She qualified. Guess what? The money's just been compounded. Okay. You dump $250,000 towards this particular policy. There's a one-time single premium payment. They're going to give you in exchange a death benefit of $331,000. Remember, with these types of vehicles, you can borrow within about 30 days. Well, Keyon, I'm borrowing my own money. Yes, you're borrowing your own money because you want to still grow interest, guaranteed interest on your own money. Okay. And if anything happens, let's just say the person lives, they pass, they put $250,000 one time. They pass away at 90 years old. The death benefit bare minimum is looking to be about $733,000. Okay. That's about 25 years later. Maybe a real estate portfolio can do that, but you're going to have to keep putting money into it. Okay. I don't know too many real estate portfolios you pay one time and then it just does what it does. Now, that seems like a big win to me, especially for people that are still trying to use their money or have the mentality of just in case I need the money. You should be buying insurance policies just like you're buying real estate portfolios. Okay? Just like you purchase a real estate portfolio, you should be paying. I don't like risk. So it's certain businesses I can't do. I won't be able to sleep at night. I don't like risk. I don't like putting a lot of money into businesses. I don't like those type of businesses at all. So if you're like me, insurance is going to be good. I can't wait to live off of 5, 6, 10% of my money. Okay? And knowing I won't lose it. So this is what we're looking at over time, looking at a compound interest. I paid $250,000, but my family got $733,000. That sounds like a win. Sounds like a great win. Okay. This is where liquidity, use, and control is. All right. Now let's keep going. Now, as you're consistently looking at utilizing these particular concepts, you will understand what I mean in the beginning by saying is based on how these are both whole life policies, but used for two different use cases. These are not the same. So you want to understand that one size does not fit all. It's based on your scenario. So you need to begin to think, where am I putting money to where it doesn't really need to go? Where am I putting money to where I know if I just up my deductible on my car insurance, I have an extra $40, $50, $60. Okay. Or if I just redirect where some of those funds are going towards my policy, I can begin to double up on taking advantage on what the government has allowed you to take advantage of. Okay. Because anything that you overfund automatically goes towards your cash value. I don't know if I told you all that, but it automatically goes towards your cash value. So you want to make sure that you're taking full advantage of these particular vehicles in that manner. Now, let's just look at an example here. I want to break something down on why it's very important to really take advantage, to really, really take advantage. Because there's so many concepts to where within your life, the interest will continuously build up over time. So a lot of you all, you're taking advantage of our Get Out of Debt program, which is really, really important. I've seen people go from 30 years of debt to 10 years of debt. In this scenario right here, we're looking at someone's auto loan, okay? Auto loan is $34,000. We're looking at a credit card, $9,000. We're looking at another credit card, $11,000. And we're looking at a mortgage, $449,000. What you don't realize is, again, you're going to owe interest. Somebody's earning interest on your money. Either you're earning it, okay, or you're paying it to somebody else and they're earning it. Either way, somebody's earning the interest. You want to figure out how to earn interest on your money. That's how you're going to survive. This is why student loans are, making a lot of money. Becoming your own bank is a strategy because they understand how to earn interest on money. Do y'all know these companies are built off of some of the biggest banks in every city, biggest buildings in every city have banks on them because of interest. They make money on interest. They don't really care about your loan. They care about your interest. They don't really care about your credit card payment. They care about your interest on your credit card payment. So when you begin to understand how to earn interest, that is when you understand that, okay, I'm starting to beat the game. Doesn't matter how big or how small the interest is, the interest that you earn is canceling out the interest that you owed. Okay, I'm saying it again. The interest that you're earning, doesn't matter how big or small, is canceling out the interest that you owe. So in the conversation I showed you, let's break this down, how to get around having to pay fees, which is a big deal. I showed you how to get around having to pay taxes, which is a big deal. Thirdly, I'm showing you how to earn interest to cancel out the interest, which is a big deal. Those three components alone will make you a superstar. Why? Because you don't pay taxes on loans, you don't pay taxes on interest. When was the last time you paid taxes on interest? You haven't, because you don't. You can probably write off your interest if you paid enough, but you're not paying taxes on it. Okay? All right, let's look back here. And then we can wrap up. Let's look at this auto loan. Let's just say, for example, we're allocating, I don't know how much we're allocating, but let's say we're allocating extra money in 5 years. 5 years, if we continuously make, let's just say 2 years. We make consistent payments. We'll be in a situation to where, of course, the auto loan, we paid in our balance is 11,000 over here because we're just making regular payments. Okay, 5,000 of that is left in interest, but over here our balance is 0, and that's just in 4 years. So we still have some years left to pay off this. Why? Because we didn't learn how to cancel our interest. Okay. It's the same thing over here when we're talking about the mortgage. I want you guys to really pay attention to the mortgage because that's where the real interest is. $412,000. Do you really think you're paying $412,000? No, you're not. You're not paying them $412,000. You're probably paying them $1 million back. Okay, more than likely paying them $1 million back. So let's just say over time, we're in a situation where we're consistently paying. Look at that. In year 17, our balance is $244,000, $244,000 over here. In 1 year, the interest that all the interest that we earn allowed us to take it off. So it saved us so much time. So watch this. In year 17 up until year 18, we paid off our mortgage. Why? Because the interest that was sitting in our account, we utilized it to cancel out the interest of the mortgage. If you're not earning interest in any other area, then you're just paying the interest. So on your original plan, it's going to take you, 28 years to pay off your mortgage. For most people, what they decide to do is they decide to double up on their payments, which is cool, but you don't get any real liquidity on that. You don't get any liquidity because the money that you're putting in, let's just say things could happen in 30 years. So you don't want to be in a situation to where you don't have any liquidity. And if you're doubling up on your payments, you're rushing for what? When you could just cancel out the interest. We don't really care about giving them the interest. They're going to get it either way, but we don't want to give them more than what they deserve. So 18 years to 28 years. So we got ourselves out of debt 10 years earlier. 10 years early. And the only thing that took us that long was the mortgage. Everything else, I mean, we really took advantage of a lot sooner. Within the first 5 years, we took advantage of most of the debt, or all of the debt, really, other than the mortgage. And we still owed some on the first auto loan. So this is where everything comes into play. Even if we look back over the 18 years, you will see over here, there's a huge difference in what you're giving out. And that's what you're looking at over time. Okay. So tomorrow we're going to IULs, break down some IULs. There's a number I'm going to drop in the chat for a lot of you all that need those updates on your policies. You need everything. Definitely make sure you reach out to this particular number. Just send a message. Everybody's number should be saved. And we have everything to you as soon as possible to really get you a breakdown, especially if you need this chart here to break down your consumer debt, your mortgage debt, so you can have a full understanding. Okay, tomorrow we're going to IULs, and why IULs are important and we're going to compare. We're going to literally compare a real IUL to real fees and everything so we can break that down. So remember everything that we just went over in detail, as detailed as possible in regards to different types of policies. We only talked about whole life. We didn't talk about index universals, and we probably touched on term a little bit, which is not that big of a deal. We also talked about different advantages of accelerated death riders, how you can borrow from your policies, why it's important to put more money towards your policies, how to utilize it, and comparing it to these other vehicles. Okay, so see you all tomorrow, same time. And if you learn anything, drop it in any of the groups that you're in, your particular groups. Let them know, hey, year-end review classes. I mean, these are really, really good. So, yep.